Hey, Saretsky here. Welcome back to the show. Lots to touch on this week. We had the Bank of Canada's rate announcement. As expected, to cut rates 25 basis points. I really want to get into that, unpack it, give you my takeaways from it, kind of what I'm looking at, some things in their monetary policy report that I think are worth pointing out, and really highlight and touch on a lot of the key themes that we've been talking about on the show for months and months and months now. So, again, as expected, cutting rates by 25 basis points. I think the one thing that I'd really highlight from this Tiff Macklem's speech is the emphasis that he put on excess supply. We haven't heard that in a while. We have not heard excess supply. We've heard excess demand, pent-up demand, and these shortages of supply. Now we're starting to hear excess supply. And so what it really means here is that we've got this weakness in the economy. We've got excess slack in the economy. We've got excess slack in the labor market. And we've seen that, right? Is over the last 12 months, the unemployment rate has increased by a full percentage point. What we're seeing in the labor force data is that we're adding more and more people into the labor force, more people, right? A lot of new immigrants, a lot of young people getting into the labor force, et cetera. And we're not actually creating enough jobs for these people. So it's becoming harder and harder for people to find a job. Number one. And number two is that companies, because they have more competition to pick from, again, are kind of able to ease up on wage growth and salary compensation. So this is the excess supply that he's talking about. And so more rate cuts are coming. They are coming. There is expectations from the market. Financial markets are pricing in another 50 basis points of cuts from the Bank of Canada. Now, some people will say, well, hold on a minute, they can't cut. What about the Fed? What if the U.S. Fed doesn't start cutting rates? What's going to happen? I think we know what's going to happen. I think we've talked about it. I think we're seeing it in real time as the Canadian dollar is going to continue to weaken and probably sell off. Canada has a real problem in that there is way too much household debt. There is way too much private sector debt. So unlike the U.S., Canada did not delever in the global financial crisis. We continue to accumulate household and private sector's levels of debt, and we simply cannot sustain these levels of interest rates without the economy seriously rolling over. And I think we're finally seeing that. We're finally seeing the economy really weaken. Again, unemployment increasing, and as Tiff Macklem points out, excess supply. So I would really kind of highlight that key factor from Tiff Macklem. Now, one of the things that they really mentioned in their monetary policy report, they also mentioned in the press conferences, they said the one thing they're kind of going to keep an eye on is, inflation. And they said the one area where you might see, some upside risks in inflation is shelter. So I said, wow, okay, that's pretty interesting because shelter is what I do. It's what I do for a day-to-day job. It's what I do on this YouTube channel on a weekly basis. You guys see upside risks in shelter. So I figured, why don't we unpack that a little bit further? Because everything that we talk about on the show, and particularly in the YouTube comments, is about this housing crash. And, it's a terrible time to buy real estate, and all these investors are losing their shirts. And so I'm kind of sitting here wondering, well, how could there possibly be upside risks in shelter? You would think, shouldn't there be more downside risks? And so I really want to unpack that because I've got a lot of thoughts and comments on that. But I think to sort of tee up this whole conversation, we have to jump over to Carolyn Rogers' comments when she was asked by a reporter about population growth and the issues that have developed in the housing market. So without further ado, let's clip those comments in right now.
Is it your belief, Governor, that the Canadian economy in 2023 would have been in a recession without the increase we've seen in population growth? And for the Deputy Governor, too, can you just talk about, in terms of the housing front, how you see that immigration boom really playing out over the medium term for the housing market?
Well, why don't you start off on the housing, immigration, and effects on inflation?
Sure. So I'll take a bit broader step back on housing. So it's absolutely the case that housing's sensitive, housing activity, whether it's construction or sales, is sensitive to interest rates, sensitive to lots of other variables too, zoning, permitting, the availability of labor, and it's absolutely sensitive to population growth. And we've had record population growth in Canada against what was already a constrained supply. So we've had a long-standing housing imbalance in Canada. I'm from Western Canada. We've been feeling it for years. It's moved to other big cities in Canada in recent years, and during the pandemic, it moved even to smaller cities. So it was there before interest rates went into sort of emergency low levels. It's still with us now that interest rates have gone up. So it's a structural imbalance, and it would be a mistake to think that we're going to fix that miraculously with a single solution of interest rate changes. So shelter inflation has some similarities. It's absolutely the case that our interest rate decisions have a direct and near immediate effect on mortgage interest costs, which is a big part of shelter inflation. But there's other things inside shelter inflation. Rent, for example, rent continues to increase. Other housing costs, insurance, taxes, maintenance, those are all rising too. We can look past mortgage insurance to a certain degree, but those other costs are real costs for Canadians, so we can't look past them. So, I mean, the bottom line on housing is we are going to lower interest rates if the economy continues to go in the direction that we expect. That'll have some effect, that'll help on housing, but it isn't the magic solution. It would be a mistake to pin all of our hopes on our housing imbalance on interest rates. Canadians need a more fulsome, more coordinated policy response than that.
So the one thing she mentions is she says, well, there's upside risk, for example, in rents, because we had this crazy level of population growth. As everybody knows, we're adding 1 million plus people a year. If you look at, cities across North America, again, including the United States, cities across North America, all the cities with the largest number of new people added to the city are all in North America. Are all in Canada. So all of the cities that are growing the quickest by the most number of people are all in Canada. This really just highlights the strains that you're seeing on these Canadian cities, right? When you think about the U.S., you're adding more people, but there's so many more different large metropolitan cities that you can go to. In Canada, of course, we know most of the immigration ends up in the GTA and then kind of trickles through into Vancouver and, of course, Calgary. So these massive strains on these cities is, of course, push rents higher. And so if you look at CPI rent growth over the past year across all of these provinces in Canada, you can see that it has been tremendous rent growth across the provinces. Now, but this is the issue, is that this tells us only what has already happened. This basically tells us turnover rents have increased by this much. This is what happened basically from a year ago. It doesn't tell us what's happening right now, today. So if you go on rentals.ca, which basically tracks asking rents in this country, it's probably one of the best resources for tracking what's happening in the rental market. You can see a lot of the big major cities in Canada are actually reporting year-over-year declines. They're showing declines on year-over-year asking rents. So we're actually seeing in real time on the ground a decline in rents. The other thing I'd point you to is, again, what's happening in the resale market. You hear it again on all of the YouTube comment section here, is how it's a bad time to buy real estate. Prices are declining. Don't buy now. Big crash is underway. We know that resale prices across most major metros are declining. So again, the Bank of Canada is coming out and saying, okay, we have concerns because there's upside risk in shelter inflation, but yet your resale home prices are declining, number one. And number two, your rents in real time are flat or declining in most of the major metros. And so you're like, well, where's the upside coming from? Mortgage interest costs. Mortgage interest costs is something the Bank of Canada controls by, raising or lowering interest rates. Well, we know that the worst is behind us because mortgage rates have stopped going up. In fact, they're actually starting to come back down. And part of that is because the Bank of Canada is cutting rates. Right? I mean, what happens to a variable rate mortgage is the Bank of Canada cuts not just 25 basis points, but now 50 basis points. Rates come down. So mortgage interest costs should also be coming down, particularly as you start stripping out base effects. So all three components of the shelter inflation again, I'm not saying that it's necessarily getting cheaper for the average person, but vis-a-vis how you look at how the central bank looks at inflation and the CPI basket, is that shelter should actually be deflating and not inflating, at least in real time. So that was a little bit of a head scratcher. Again, I know that Carolyn Rogers flagged immigration growth. Again, should it persist? I think you could argue that, it could reignite further strain on the rental market, but I really don't see that happening. I think that population growth is going to continue to weaken and roll over as the feds mandate a lower percentage of non-permanent residents coming to this country, as they tighten up on these foreign worker programs, on these student visa programs coming into the country. I think you're going to see that. Not only that, but the weakening of the labor market as these immigrants come here and there's no jobs for them. That is naturally going to be restraining for more and more immigrants coming into the country. So I actually think population growth is going to continue to weaken. And then, of course, what we're seeing in the rental market, right? I mean, there's this big theme. We've been talking about it. I see it in Vancouver. It's certainly not as pervasive as what you see in the GTA, but we have all these condos under construction. In fact, we have record number of condos under construction. It's great. We need it, right? I mean, people say, hey, it's a free market. Supply will help cure a lot of problems, right? I mean, so build the supply, and we've been building it. The supply is coming, okay? So the supply is under construction. It's coming due. And it's coming due at a time when not only are resale prices declining in many of these markets, but we know the rental market, rent prices are starting to decline. And so there's some great charts from CIBC out this week showing what's happening in the new construction market. Again, as these units come up for completion, people are going, well, it's not worth what I paid for it 3-4 years ago or 2 years ago. It's not worth it. I'm going to lose money. So what I'm going to do is I'm going to put it into the rental pool. Yeah, the rental market's a little bit softer, but it's still not bad. So I'm going to go into the rental market. And so what we're seeing is the CIBC did some research showing the number of newly completed condos in the GTA that took on a mortgage. How many of them are negative cash flow? 81%. 81% of people that recently closed on a condo with a mortgage, 81% of them are negative cash flow. And it gets even worse if you look at the position of cash flow. You say, well, how negative cash flow are they? The average negative cash flow position is hovering around $600 a month. These are significant. These are significant. So I think this is really, really important to watch. And this is why we're seeing more pressure on the market, right? If you're negative cash flow $600 a month, how long are you willing to hold that condo for? How long can you carry the burden of losing $600 a month? Can you do it for 3 months, 6 months? Can you do it for 2 years? I think there's a lot of people that can't necessarily hold on that long, and we basically be forced sellers. And so again, this can put more downwards pressure on, you guessed it, shelter inflation. So I think these are really, really important metrics to watch. I think immigration plays a key role. I've heard comments before saying, immigrants, they're all poor. They just come here. How can they put pressure on the housing market? And that really couldn't be further from the truth. And we see this actually again in the Bank of Canada's data showing number of immigrants that come to this country. Initially, they start off as renters. Naturally, you come here, you're trying to figure it out, feel out what's going on, get a job, start saving some money. So you're going to rent. But as you start living here longer and longer, and by basically year 10, roughly 50% of immigrants become homeowners. So that's pressure on the resale market. Of course, when immigrants come here and rent, they're competing. They're competing for a shortage or a constrained supply market. They put upwards pressure on the rental market. Upwards pressure on the rental market is an investor's cash flows, right? So as an investor, if you're obviously going to pay more for higher cash flows, I mean, that's just obvious math. And so immigration is something we certainly have to keep an eye on. It can certainly prompt upwards pressure on shelter inflation, but I think the worst of the immigration side is behind us. I think that what's going to trump all of that is the excess supply in the new construction condo market, the amount of negative cash flow investors. And again, I think there's a psychology here that it was a lot more compelling to hold a negative cash flowing condo in the GTA or in Vancouver, for example, when, it was 2022 and your mortgage rate was 1.8%, you're paying 55 to 60% of your payment from day one was going towards principal. And everybody had the view and the belief that prices were going to continue to go up. Maybe they're going to go up 5% a year, maybe they're going to go up 10% a year, but they're going to go up. And so you're much more willing to absorb a negative cash flow position for future growth. And I think the prospects today, people go, well, prices are down. They're really not going anywhere. Are they going to go anywhere if mortgage rates stay in the fours? What is the future growth? How long can I hold on? And holy smokes, there's a lot of units coming to market. So that's kind of my takeaway from everything that happened this week in the housing sector, in the Bank of Canada's monetary policy report. More rate cuts are coming. The Canadian dollar is probably going to sell off further. There's more pain still coming in the housing market. I know the Bank of Canada's, citing concerns about reigniting shelter, and I just don't see that. 50 basis points or even 100 basis points of rate cuts is not going to suddenly turn this housing market around, given everything I've just talked to you about units that are under construction, coming to completion. And the math really has not fundamentally changed for most of these investor units and investor pre-sales. So, as always, hope that helped. See you next week.